Welcome to the Four Seasons Podcast, brought to you by B&H Wealth Strategies, serving Northeast Tennessee and Southwest Virginia since 1966. Here, we guide you through the ever-changing seasons of your financial journey, offering insights to help you grow, protect, and enjoy your wealth. Ready to turn your financial dreams into reality? Dare to dream. And now, here's your host, President of B&H Wealth Strategies, Jeff Bingham.
Market swings can make even the most seasoned investors uneasy, but how much should you really worry? We're revisiting market volatility, what's causing the current shifts, how to navigate uncertainty, and whether it's time to adjust your financial strategy. Welcome back, everyone. Skip Monty, co-host / producer, back in the studio with Jeff Bingham, president of B&H Wealth Strategies. Good to see you, Jeff. How's it going?
I'm doing great, Skip. How are you?
I'm doing just fine. I'm a little nervous with what's going on in the market right now, and not real certain about what I need to do about it. So I'm sure it's on everybody's mind as well, in addition to me. So let's break it down and help our listeners stay grounded in their financial plans by tell us, how concerned should we be about market volatility?
That's the first question, really?
Yeah, sorry. It's kind of deep.
Easy answer to that. No, I don't. Again, I can't tell people not to be concerned about market volatility, and that's not what I'm going to tell people or tell my clients or anybody that I'm ever talking to. But I think you got to separate the news from the noise, and consider which news noise is always trying to give you, which is trying to create chaos, which is always going to give you the worst side. I don't care it really doesn't matter whether you're inclined to watch Fox Business or CNBC Business or just the national news, wherever your du jour, your choice is to go find your news. It's angled and driven to create emotional responses. And money is a very emotional thing when we're investing our money. And so you combine money already having the emotional connection that it has with us individually with news that then is there 24/7 all the time. And you can go to Twitter and you can go wherever, to Facebook or wherever you're going. It's a wonder that people can keep their wits about them. Sometimes it really is. And what I've always tried to do, and I learned this years and years ago working with my dad and Norman, the two founders of this business, is that it is our job to be the stabilizer in this conversation, to kind of be clients' insurance from making really bad mistakes with their money. A properly constructed portfolio, in my opinion, would be one that you're not going to eliminate losses. You're also not going to hit home runs all the time, but a properly constructed portfolio that suits the client's financial needs as well as their comfort zone needs should be something that doesn't really have to be changed very often based on the movement of the market, either up, down, or sideways. Doesn't mean you don't do anything, but if you're making big changes, then you're not properly constructed. That you have either misread or misrepresented, if you're doing it on your own, or misrepresented what you can take on as far as risk is concerned. We go through quite a process that is both, there's art and science to profiling a risk, what we call a risk assessment for a client. And then, so we match their financial needs and their comfort zone needs. And if you do that, and we do that well, and the client is constructed well and is given that information appropriately, properly, if you will, then you should have a portfolio that's going to survive both the up and the downsides and the sideways, as I said. Sorry, that was a long-winded answer to that. But the other thing is that when we talk about volatility, we think it really just cuts one way. We automatically think volatility to the downside. Our minds immediately go, big sell-off, going down, losing money, can't go down. Volatility is just, and in my opinion, volatility to the upside, like big moves to the upside with very little downside for pretty long periods of time, is just as as dangerous. It's just as scary. Not to the client, because client sees counts going up. But on my side of it and sitting in my seat, that's a scary thing because it doesn't go straight up. And so we know when we see years like coming out of 2022, we see 2023 and 2024, the S&P 500 goes up in excess of 25% with very little downside movement in either one of those years, uninterrupted, to 25% on the upside, two back-to-back years. Hadn't happened since 1991 or 1991 too, or 91 and 92 or something like that. So it's been 30 plus years since we've seen something like that. And so when we moved into this year with in some ways, I think the economic hopes and the movement and the exuberance from the Trump election towards the economic cycle and everything that was going on, the market began to move up again quickly. And then he unleashed the tariff on April the 2nd. He unleashed the tariff idea, and he dropped the mother of all bombs and the tariff. So on April 2nd, he dropped that. And for a week, the market sold off. I don't get the numbers right, but we were off, I think, at that low for the year at that point in time on April the 9th. And so this won't be exactly the right number, about 10%, let's say, on the S&P 500. And from a peak to trough, because in February, the market, again, as I said, we were rallying in earlier, and then the market began to drift off of that high in mid-February-ish. And so we really were off about 20% almost, which is characterized as a bear market close to that at that April 9th low. And I think April 9th was the low, so clients don't hold me to that date too tightly, but give or take right there. But since that point in time right there, the market has turned around, and we just finished the first half of the year with the market was up the S&P 500 was up between 5 and 6% for the first half of the year. The bond market, which again, one of the fears of the tariffs, and there was going to be high inflation and interest rates were going to go up. And actually, interest rates have gone down since then. And the bond market has had its best total return in a number of years. And inflation has subsided through that. So that doesn't mean that it won't go the other way. But you think about the point that I'm making there is that the knee-jerk reaction of listening to the news and watching what the market did for let's say a week or so, right, which is just enormous sell-offs, multiple thousand of point sell-offs, percentage points. I don't know, we were off the first day or two of it. It sold off nearly 10% in a day. I think the S&P made 8% during one day. It's not exactly right, but roughly that. That's a huge number on a sell-off right there, and that is enough to scare the living daylights out of people. But again, you and I talked about this on the air. I talked about this with clients. I dropped a quick fire video on it. Just said, hey, be patient, because your instinct is, I want out. I don't care what you tell me. I don't care that I'm diversified. I don't care that it's going to come back. I'm afraid I'm going to lose all my money, right? I'm afraid I'm going to lose all my money. So you sell out and you move to cash. And cash is also a place. And when I say cash, I'm talking about interest-bearing cash. So in today's world, on a 4-ish% interest rate deal, we were 5 this time last year, about 4 this time this year, but risk-free. It's not unattractive. And several years ago, you weren't making any money there. So you can go park in cash, right? I can make 4% on my money. It's not losing. So the instinct is to do that. But the problem is, if you move to cash at the right time, let's say, you also got to be right again. When are you going to go back in? So you're going to move out and you're going to come back in. Okay, so the market rallied. If you would have done it during the sell-off between April the 2nd and April the 9th, if you'd have done it in there, or even from February 19th until April the 9th, somewhere in there, you'd have moved out of the market. Would you have gotten back in at any point in time between April the 9th, when it started rallying back, to June 30th, or to the end of the first half of the year? Would you move back in then? Probably not. Or would you move back in now, as the market has now at all-time highs again, right? The S&P 500 and the NASDAQ closed at all-time highs yesterday once again, or the day before, I think yesterday as well, but maybe the day before, if we sold off a little bit yesterday, but not much. So I'm saying, like, what do you do? and not the best of the best, not those that we were talking about in a previous episode where I go and I see traders that are on the floor of the New York Stock Exchange, the best of the best. They don't get it right. They don't try to time the market. They don't jump out and get back in. They sell and they move and they manage money, but they're not going 100% to cash. They're not good enough to do it. How in the world do you think that you, as a client, as an investor, are good enough to make those decisions right there? Because again, think about it. If you waited till the end of the quarter, if you jumped out, even if you got it maybe right, or even close to right on the sell, now you got to decide when to get back in. You're like, it looks pretty good right now. So you jump back in now after the market's rallied back up, and let's say this bill gets delayed, or God forbid, it doesn't get passed, right? It doesn't make it through it. It gets voted down. It's possible. And I can assure you that's not going to be good for the market. And if you jump back in because the market's moved back up, oh, it looks good, the momentum's there, the big, beautiful bill is going to get passed. I feel confident that's going to happen. You jump in and it doesn't, or it just gets delayed. And now you go down again. So you lost money. You lost momentum on the way out. You didn't get to participate in the rally back to June 30th, and it goes down again. That's the rinse and repeat, right? We used to say, if you do that on a regular basis, that's a way to manage to go broke, right? That's how you go broke, is trying to move in and out of the markets. Long-winded question to volatility, but if you're going to be an investor, and you're going to own assets that I think that most people need to own, which is growth, which is have growth in their portfolio to outpace inflation, which is going to be stocks. U.S. stocks are the best place to be, bar none, in my humble opinion. Doesn't mean you don't have some diversification internationally and that kind of thing, but U.S. stocks have proven over and over again that they're the place to be. They might go down in value, but they've always come back. When markets go down, they always go back to new highs. And again, low on April the 9th to the high, and the new records that we've set as we closed out the quarter and we moved early into the third quarter of this year. Build a portfolio, stay the course. Doesn't mean you don't do things, right? And then adjust, tweak. Yes, you tweak portfolios all the time, but use the right tools that are comfortable for you. Unless your plan has changed, unless your circumstances have changed, it is not often a good idea to change your portfolio based on the changing winds of Washington, the economics, the geopolitical scene. You try to do that, you're not going to make the kind of money you ought to be making as an investor, right?
So, sounds to me like your advice is stay the course, stay calm, don't necessarily react to what's on the news, and stay the course.
Absolutely. I was thinking, and I'll do this real quick. I know we don't have a lot of time left, but sharing the story with you off air about what happened in here yesterday morning with the flood in the kitchen.
Right.
And in the moment of chaos and panic when that was happening down there, it looked like I was like, everything is going to fall through the floor. It's going to fall to the basement. This water's never going to stop. It's not ever going to stop. Because we had a water issue here in the office, and it was just filling up. And the panic that was there that I had of that. And then, but once the water gets cut off and you evaluate the situation, you put it back together, but if that makes sense, that's the volatility of that moment is what you want to react. It's horrible. The world is coming to an end in that regard. Yet we have the right tools. We have insurance in place. We have all the right tools. We have all the right people that we know that came in, cut the water off, got the drying going on, put the floor back together. That's life. That's investing. They all look the same. You have to be calm. Make sure you have the right tool set in place, the right strategy for you. And unless your strategy changes or your situation changes, your needs, etc., your portfolio should have been constructed in a way that can get you from where you are to where you want to be in a manner in which you want to get there.
Awesome. Jeff, I can't thank you enough for your insights, which today are invaluable. And I want to thank you for helping me and our listeners for to help us navigate market uncertainty with some clarity. And to our listeners, we'll see you next time with Jeff for more financial strategies to keep you moving forward. Jeff? have a great rest of the week and a great 4th.
Thanks. You do as well. God bless, Skip. Thanks. And God bless America.
God bless America, brother.
Thanks for tuning into the Four Seasons podcast, brought to you by B&H Wealth Strategies, where your financial success is our priority. Schedule your free 20-minute consultation today by calling 423-247-1152 or by visiting bhretire.com. Take the first step toward making your financial dreams come true. Until next time, remember, every season is the right season to plan for your future. Securities and registered investment advisory services offered through Silver Oak Securities, Inc., member FINRA SIPC. B&H Wealth Strategies and Silver Oak Securities, Inc. are not affiliated.